I'll kick off then. Okay, well, thanks. Thanks everyone for joining. I can see we've got 60, 65 people in the room there, and people from all over the place from the UK, such as David. Hi, David. How are you?
I'm very good. How are you?
Very good, thank you. The UK, the Middle East, and Asia, where the bulk of our clients are based. So what are we doing today, guys? We're keep it fairly short, 20, 30 minutes if we can, because I know we live in an age where attention spans are falling. So we're going to be speaking with David Yelloly of Prosperity Developments. They're Birmingham-based developer, Birmingham's largest homegrown developer, actually, and basically looking at sort of what's going on in the UK market at the moment and why we think there's still opportunity out there and how you can actually use the current market conditions to your advantage. So we'll have a chat with David about that, and then after that, we'll look at for those clients that are here on the chat. Hello, clients. I can see we've got perhaps 20 odd. We'll do a bit of an update on some of the sites, David, if that's okay. Birmingham,
yes, that's
Ford
cool.
Oaks, all that sort of stuff, and sort of to keep people in the loop, which is what we like to try and do. So just for those of you that are new, we put this out on LinkedIn, and we had, I think, 130 signups. So for those that don't know APW. What do? We basically help expatriates and international people purchase UK property. That's generally investment property, but doesn't have to be. In one form or another, we've been doing that for sort of 30 years now, and we help with the whole process from sort of the sourcing to the mortgages, the tax, or the eventual sale if you want to sell it on. So all of that sort of stuff. And how do we do it? We basically start by having a conversation with you guys and sort of find out what you're trying to achieve, and then we go and look for that for you using people such as David and sort of some of our other networks. So that's enough about us. Perhaps David, just a sort of a brief intro from yourself, and then we can jump into some of the sort of current market stuff.
Yes. Good morning, everybody. I'm David Yelloly. I work for Prosperity Developments. We're a property developer based in Birmingham with projects scattered all over the UK, but primarily, I suppose, a proliferation of properties in the West and the East Midlands, but we do go as far as Halifax North and as far south as Southend South. So we've been doing this for 15 years. In the early stages, we were focused on providing property advice to expatriates, hence the connection with APW, because we kind of started doing it at the same time. A lot of our clients now are domestic, UK based as well, as the company's expanded. We've sold well over £4,500 properties over that period, from small apartments in 10 or 15 plot developments up to 230 apartment blocks, unit blocks. So a big spread there, and also we're in the new homes market as well. So we're building homes for both the owner occupier and the investor market. So a very wide and diverse spread of property all over the UK. We too are invested in giving clients advice not just on property, but on property related assets. So we work hand in hand with companies like APW to help people create wealth through property and provide for their children's education, their own retirement or inheritance tax planning, etc. But fundamentally using the good old traditional asset of bricks and mortar, which over the years I think has probably been more reliable than most other asset classes.
Brilliant. All right, thanks, David. So just for those, I just was thinking of a question then, just for those people that are new to the Prosperity concept, obviously, aside from your track record and your experience within the space of, not just domestically, but bringing the properties to an overseas marketplace, what is your sort of main USP that other developers and people based out of the UK are not doing? What makes the Prosperity approach so appealing?
Yeah, going back on the history of Prosperity, in the late noughties of this century, we decided that what we wanted to do was to provide an investment product based on bricks and mortar and acquiring property, but that was, if you like, quite similar to the type of product that you as an international investor or an expatriate might have seen before in the financial services market. So the regular savings plan. I'm sure you've all come across products from the likes of Holden and De Vere not necessarily all of them particularly good, but you've come across products where you've been offered the opportunity to invest your salary or savings in a monthly savings plan to generate capital appreciation on your underlying funds. And some of those products, as I say, weren't great. So we felt that if we came into the market and offered people the ability to start investing in bricks and mortar by paying a monthly amount of £1,500 or £2,000 a month into that type of product rather than a savings product, it might have some appeal in the open market and the wider market generally. So we came up with a structure where we would buy land or buy property with the view to develop it. We'd get planning permission on that property and then start construction. And at that time, we would then go out to the marketplace and talk to people about being able to reserve plots off plan. So it's this whole concept of off plan property investment, and start saving on a nice, easy, low commitment basis, and building up their deposit over the build process, whether that was 12 or 24 months or whatever. So so the model, it took a while to convince people of its merits, but as I say, we've been pretty successful certainly over the last 6 years in getting people to buy products on this basis, and it does appeal to people. So rather than paying a very large deposit, which a number of our competitors ask clients to do, we seek to obtain a small deposit or a modest deposit, let's say 5% of the purchase price. And then the client can pay the balance of the deposit due, which in the investment market is typically about 25 or 30%. They can pay that over in monthly installments over the remainder of the build period. So it's quite realistic to assume that if you're buying a £200,000 apartment, you might end up paying something like £2,000 a month. And over 2 years, you'll have accumulated enough deposit to then go forth and get a mortgage. And our whole principle is to provide that from start to finish product, where we find you the property, we set up the facility to accumulate your deposit, we build it, we provide you with regular updates. Then when we get close to completion, we talk to you about mortgages and whether you need finance, although APW are very well versed in that sector as well, so they can provide similar and complementary advice there. And then if necessary at completion, we can find you a tenant and manage the whole process of the property in terms of generating an income for you, remitting the income back to you, and helping you to finance the mortgage costs. Ultimately, you may want to sell it and capitalize on your investment, particularly if it's gone up in value, particularly. And at that stage, we'll be quite happy to act as an estate agent and remarket the product or the property to our clients, and also people off the street who are looking for property in the area in which they live. So it's a very comprehensive overall service.
And I would say it is a very popular model, that sort of paying for a property on the drip, and it is an easy model as well. When you're living overseas, I know myself from trying to purchase property in the UK. If you're trying to purchase sort of what we call second-hand property, existing property, terraced houses, whatever it may be, it's very difficult when you're not actually on the ground to be able to go and sort of looking at these properties. So it is an easy way to get into property for people such as ourselves that are overseas. I just wanted to say for people, this isn't a video on off plan, but we have done a video on off plan with David before, where we actually did a tour of a completed property and went through the pros and cons of off plan. That's on our YouTube, and we'll put sort of the link or something down below or in the description or whatever it may be. So if you watch this and then you want to go and watch that, you can do. But David, thanks very much for that. Let's have a quick chat on sort of the where the opportunity may be in the market at the moment, and sort of there's a lot of doom and gloom. I feel like it's clearing a little bit at the moment, but it's sort of been very negative. If you read the papers, and a lot of people we're speaking to are saying, well, I'm going to wait for the crash and the dip and whatever it may be. So what are I'll start. I would say, post-COVID, we're seeing a reversing of the trend we saw in COVID, which is the race for space. now everyone realizes they do need to be working from an office, or at least a couple of days a week, and want to be back in the city and want to be around other people. What we are actually seeing is a strengthening of the sort of the city centre market, you know, and the units, the 1, 2 and 3 bed units that sort of younger working professionals are going to be renting. So so that's a positive. You know, the sorts of units we're looking to purchase as investors, which are city centre stock, you know, those are performing better than they have over the past 2 years, and sort of demand for those is going up. So I think that's one positive. Do you agree, or have you got
Absolutely, yes. The dynamic, the effect, the COVID effect has been fascinating, and of course we're surrounded by clever people, economic analysts, who tell us what's going to happen when there's some trauma in a market. But invariably, in fact, they'll admit themselves they get it wrong 50% of the time. But there's no doubt that in retrospect, a lot of what has happened since the pandemic wasn't necessarily predicted. And I think one of the fascinating ones from our point of view is, I think what had been happening prior to the pandemic was that the youth and the younger people in the UK had been building up savings. I think there was a natural tendency for people. We'd had a good run in the economy, you know, not full employment, but pretty close, and people were starting to save money, a low interest rate market. And the pandemic comes along, and young people, obviously not all, but people in, let's say, conventional or normal jobs who'd accumulated money, probably with the ambition of buying property, then found themselves having to dig into their savings, either because they were unemployed or furloughed, and it's actually eroded their capacity to buy property again. So this has bolstered the rental market, whereas we were seeing a trend towards people buying homes more often, you know, starter investors buying their first home. That trend has dissipated markedly over the last 12 months, and it is just down to affordability. People don't have the money to do it anymore. And then combining that, the lenders have become a bit more conservative about lending money, and small deposit type mortgages, you know, with 90% mortgages. That market has declined a bit. So it's a perfect storm, really, of making it less possible for people to buy those first homes. And so what we've seen is a return to the rental market. And as Callum says as well, there was a clear migration out of the cities during COVID for the green fields and the space. But you know, I work in the centre of Birmingham, and there's just this huge energy back in Birmingham now, and the streets are busy again, and people want to live close to work, and they want to socialise, and they want to go to the office. So yes, it's been an about turn, which I don't think I was predicting 18 months ago either. So fascinating, really.
Yeah, and I mean, it's always difficult to say. I mean, I remember reading a report from, is it CEBRE or CBRE at the start? Yeah, that's it. At the start of the pandemic, and they were predicting a 14% fall in house prices, and you know, we had the opposite. We had house prices go up 14%. So sure. It just goes to show. I guess that points to, you know, you need to make sure you're doing your research when you're making any sort of buying decision. You know, if you're buying out of the country now, it's probably, unless you've got strong transport links into a sort of center of employment. We always like to say, use the PI formula, which is population, infrastructure, employment. You know, if somewhere's got all of those things, then generally it's a pretty solid location. So, okay, that's good. I guess just a quick note on interest rates. That's been pretty, you know, a pretty hot topic recently. We ran an event in Singapore a couple of weeks ago, and we had Scott Mitchell, who's one of the guys we work with, for those people listening, and he's based in Singapore and helps people get mortgages. And he was saying in his talk actually that it's actually cheaper to get a 5-year fix as an expat than it is as a UK resident. You can get he can still get expats at 4.49% on a 5-year fix, which you can't get in the UK. It's sort of 5.56% in the UK. So there are positives. I mean, that's not too bad of a rate to be getting. What do you think is, you know, where do you think the mortgage market is going, David? I think we've seen the worst of it, probably.
Yeah, definitely. I think we've really got to look, whenever we have these periods of volatility, you have to look, back into history a few years, and just to try and work out what's gone on and look at the macroeconomic climate. So I think the UK as a developed economy has been more affected by the traumas of the last few years than any of the other major economies. And so we have to try and understand why that is. And of course, what we had was Boris, for better or worse, deciding that he wanted to get the UK out of Europe and achieving that goal. And I'm not politically driven at all, so I'm pretty neutral about whether it was the right or the wrong decision at that time. I think it was pretty neutral, but he then had the worst scenario that he could have had almost immediately afterwards. Within 6 months of that, we had a worldwide pandemic, which reduced the capacity of countries to strike new trade deals, and for mobility of employment. And everyone shut away at home, not being enterprising. So that really decimated all the plans that the UK government had for opening up new avenues of trade to replace those from Europe. Then as we came out of that, then there was the slight irritation that the Europeans had with the UK, so they became a bit awkward about allowing us to transport our goods each way across the channel. So that caused problems. And then as we got through that, we then had the Ukraine-Russia war, which created a whole new problem with supply and demand of goods and raw materials, etc., further causing problems. This damaged the political status in the UK. So Boris was then the focus of attention in the media, and we found out he'd had a few parties at Downing Street, so he had to resign. And then we rushed into appointing somebody who maybe in hindsight wasn't the best person, who made some very, very ambitious decisions regarding economic strategy, which just upset the market to such an extent that we had huge concerns about inflation, interest rates rising, and currency falling. And so that really has been a nightmare scenario for the UK. And as a result of that, we had this huge spike in interest rates. But we've had a huge spike in interest rates pretty well everywhere in the Western world anyway. Yeah. And if we look back in history, what's happened is we've had a period of suppressed interest rates, where interest rates have been unadvisedly low. It's just they've been too low for too long, and this has created this pent-up ability for people to save money and to be quite blasé about debt. And so this was a problem brewing, and the UK's position has been worsened by the fact that it decided to, I think, exit Europe at a time when you wouldn't have done it if you'd known all these things were going to happen. And it's a bit unfortunate, really. But the fundamental around all of this is, despite all these traumas that we've had, the property market has actually continued to rise in value. And yes, we've had some indicators showing that there's been some market falls over the last couple of months, but they're relatively modest. And if you take them against what's happened in the previous 24 months, it's really insignificant. So the appointment of Sunak has definitely stabilized the economy here and regarnered confidence in the people in the city, which I think is very important. We did have this spike in interest rates, but if you look at the interest rate trends over the next 12 to 18 months, they're all trending down quite markedly, progressively. So that this time next year, I think personally that we'll be seeing base rates for mortgages at about 3.5%. So I think there is this peculiar period at the moment where if you needed to get a mortgage today for a purchase, it's difficult, and you wouldn't necessarily be doing what our normal recommendation would be, which is fix your rate and know what your commitment is, because you wouldn't want to fix at the moment because the trend is downwards. So we are seeing rates coming down quite rapidly. and the lending is starting to increase again. And from our own point of view, whereas in the autumn we did see a drop off in new business sales, new reservations, we're now back up. In fact, it's a bit higher this month and for the last 3 weeks than it has been for a couple of years. So at this time of year, so I think there's a trend to buying property again, because it really is a safe haven, particularly residential property, I think. And the UK provides this great fiscal and legal environment for ensuring that you can buy your bricks and mortar, and it'll always be your bricks and mortar, which isn't necessarily the case in other parts of the world.
Yeah, and I think that's it. The situation, it is a live situation when you're looking at purchasing UK property. I mean, if we were speaking to clients sort of 3 or 4 months ago, and as you just sort of alluded to there, the advice would have been, well, let's get it fixed for 5 years at sort of 3 or 4%, whatever we can get, which is a great rate. Whereas the advice now might be, well, if you're buying now, then maybe look at 2 years, and then we can remortgage in 2 years' time onto a lower rate. Which I guess is, unless you know your stuff, we could all learn more, is why it's important, I guess, to work with people like yourselves, or at least do your research. You don't need to work with people like us. You can go and look at our YouTube and read other people's content and stuff like that. But last question before we look at some of the so for the new people, this is the last question, and then for clients that are listening, we'll look at some sort of current examples and updates, that sort of stuff. What would you say then, David, to people? I know what I would say to people that are saying, I'm going to wait for the crash, or I'm going to wait for the correction, which, there's in some cases are people that, who were waiting to see what happened with Brexit, and who are waiting to see what happened with the US election with Trump, and the same people that were waiting for whatever it was 5 years ago. So anyway, what would your advice be to someone that says, look, I'm going to wait until prices cool and buy then?
I think there is always going to be an underlying trend for property to rise in value. Being clever enough to pick the absolute bottom of the market or the top of the market is just not possible. If you do it, you've been lucky. So really, the thing to do is always be very careful about where you invest, and do your research and make sure you're investing in a place where there's going to be a rising demand for property, and where there are very clear reasons why that rise is going to continue. Birmingham is a prime example. There is so much going on in Birmingham, despite all these events of volatility that we've had over the last few years, and Birmingham is a fantastic place to invest. But yeah, I think sitting on your hands and not doing anything is a strategy that really doesn't work for investors. If you think about the last 5 years, we've had all of this volatility, and in fact, I'm just dealing with a sale for a client now. Somebody bought an apartment from us in the centre of Birmingham in 2017, and she paid £138,000 for a 1-bed, and she's an international investor, and she's not really being all that interested in the investment. She made it. She thought it was a good strategy. She thought a 6% yield would be good, but she wants to sell now because she needs some money to buy a home for herself. And her view, without doing anything much in the way of research, was she'd be lucky if she got her money back. And so just factor in, she's had 6% per annum for 5 years. She's managed to reduce the debt on her mortgage quite markedly. But she's sold that property for 180,000. So, and she said, well, I was listening to all the media in the UK telling me about how bad things were, and I just never for 1 minute thought my property had gone up in value. And you're telling me I've made the best part of £50,000 and reduced my debt through my rental income. She said, what a fantastic investment. So I think that's the point, and that's through this period of volatility where a number of risk-averse people have said, oh no, I don't think I can do it yet, it's not the right time. Well,
that's it. And
it was hindsight, wasn't it?
Well, this is it, benefit of hindsight. But I think that even if you take property prices out of it, you're looking at the fact that you're getting a yield, 5, 6, 7%. You are actually getting an income from the property, and a lot of people, I think, overlook that. They just get so caught up on what a property price is doing. Well, actually, you're still getting, a great yield and a good income from the property, regardless of what prices are doing. And if prices fall 10%, your rent's not going to fall 10%. It's very inelastic. It will stay the same, and you'll still get the same. Technically, your yield will go up if the price falls. But anyway,
and I think that's a really good point. Just on the, for those people who have not invested in property as an investor, then I think the one thing is that in periods of volatility, the best asset class you can buy is one that at least generates you an income. Don't buy something that's just you're buying it on the prospects of the capital growth. A huge number of people over the last 2 or 3 years have invested in watches, and some of them have done very well if they've sold, because the market has been short supply, and watches have gone up hugely in value, high demand watches, but they're all tumbling down again now. Yeah. So it would have been, if you could generate an income from your investment, at least you're mitigating the risk of not being able to time your purchase and your sale. And that's why property is such a good underlying investment, is it generates income on a monthly basis, and that de-risks the whole principle of the investment, because you can't go wrong if it's generating an income for you month on, month out.
Wonderful. Okay, excellent. I think we'll leave it there on that part of it. Thank you. So for 60, 70 people that are still in the room watching, we'll send this out to you so you can watch it again. And if you want to have a chat with sort of ourselves or David, then just get in touch. And like I said at the start, that's how it usually works, is we just have a chat and see what you're trying to do and see if we can help. There may be a fit, there may not be a fit. But we'll have a chat. And then, so for those clients that are here, I guess we'll just have I wrote down here, perhaps we can just sort of go over what's going on in Brum or Birmingham and the Birmingham developments, then have a little look at Broadoaks and Cambridge, and then perhaps just a scoot over the PD permitted developments, right? So the conversions and the sort of the lower price point units that are coming through. So we'll try and give ourselves 10 more minutes, and then we'll wrap up if that's okay.
Yeah, fine. Okay, well, looking at Birmingham first, we have 2 projects where construction is underway in Birmingham. One is called JQ Rise, and the other one, Part U. We had an open day 2 weeks ago where about 50 clients came up over the course of the day, did 3 different visits to the sites. I think they were all really pleased with what they saw. We have had some challenges with the construction on particularly JQ Rise, not so much Part U, through COVID and supply channels for raw materials and fixtures and fittings, but those are all behind us now, and work is really progressing apace. So each of those projects will complete around from December next year. So it's quite a rapid increase in the amount of activity on both sites now, and we're seeing huge changes. JQ Rise, for instance, has got 2 enormous cranes up, and we're erecting the outside of the building now, the structure of the building, which is very exciting. That's a over 20-story high building, so it's really going to be a landmark building in Birmingham. And Part View, the structure of the building is already up, and we're starting to fit out on the lower floors. So exciting times in both of those projects. Part View is pretty much sold out. I think we have three plots left there, and JQ Rise, which is a large project of 226 apartments. There are, as of today, 13 units that we've just released the last phase of 13 units left at JQ Rise. So they're really successful, again, being sold through this volatile period, but still a really strong demand from international and domestic investors alike. So Birmingham is, as I've alluded to earlier, it's a hot spot, definitely. prices have risen over the last 5 years, as I inferred just a few minutes ago. But it still represents great value when compared with the other big cities like London and Manchester and Liverpool. And Birmingham's proximity to London, the fact that HS2 is really underway. The project is, you can see signs of the project everywhere, and it's really progressing very quickly, and I have no doubt it will be complete within 5 years. It's really great news for Birmingham, and is factored into the growth in Birmingham already. That's why we're seeing these big corporates coming to Birmingham, like HSBC and Morgan Stanley and KPMG and the Inland Revenue, and all leaving the southeast of England and coming to Birmingham for the cheaper property, lower salaries that they need to pay to employ high quality, well qualified people. So Birmingham's very good news. But quite apart from that, all the other city centres around the country, if we do our research properly, they're good news as well. If there's a new hospital or a new road link or a rail link or an airport, or success in a company like AstraZeneca, this drives the energy and wealth of the city, and that therefore drives the need for accommodation for young professionals and others to live there. So all good news really in terms of Birmingham and the main cities, I think.
Yeah, and those were all the, I guess, the things we were talking about earlier. People sort of returning to cities and using that the pie to make sure you're buying in the right sort of location, population, infrastructure, and employment. All of those sort of things do lead to a location being a good location. Just quickly on Birmingham, you mentioned sort of HSBC, Deutsche Bank, those sorts of people. Are these the sort of people that will be targeting to be living in, new builds such as JQ Rise or?
Yes, so we, as I said earlier, we have our own lettings management company. So the way we work, when we have a new project getting close to completion, we communicate with the local offices of the companies like HSBC, particularly HSBC and Deutsche Bank, and just make it obvious to their personnel department and their catering and wherever we possibly can, that there's the facility for new accommodation, and this is probably where we get the majority of our clients from. Although it's amazing how the referrals from existing tenants work very well as well. So once you've got a tenant in who's happy with the property, they tend to tell their friends. So you find people coming and approaching us saying, do you have anything in JQ Rise or B1 Edward Street, because my friend lives there. So
wonderful.
As I say, the rental demand in Birmingham is exceptionally high, much higher than anywhere else that we actually trade in at the moment. It is because of this unique series of events that's taking place in Birmingham in terms of its expansion, and I have no doubt that that's set to continue for another 5 years.
Wonderful. Okay, thank you. All right, just sort of last 5 minutes on perhaps just a bit of an update on Broadoaks, which is
Broadoaks was
sorry.
Yeah. Sorry. Broadoaks was our. I'm conscious of your 5 minutes. Broadoaks was our.
That's okay.
Was our first foray into a big housing development, and hindsight is again a great thing, isn't it? But we realised that building 250 houses is much more complicated than 250 apartments, and so the project was a very substantial project for us. And I think in hindsight, we possibly weren't geared up for it quite enough at the time, particularly launching it in the middle of the pandemic. But we've managed to get everything in order now, and that project is well underway. And I'm pleased to say that the first 75 contracts have been sent out for people who've reserved. We've got over 150 people who've reserved. So we're halfway through those now who've now got contracts at their lawyers for them to review and sign up to. So
and so will will the remaining 75 be going out as well, or are they going at a later date once the first?
Progressively, but yes, not in a batch, but over the next few months. But yes, definitely.
Sure. Wonderful.
So that's all good. We still have units available there, probably about 30 or 40, but we won't be releasing those until the new year now. So they'll be available. But the market for that project, this whole idea of some greenfield space, families wanting to live in houses rather than apartments. Going back to what I was saying about the mortgage market, young people no longer being able to buy their own homes, so looking to rent, has meant that the investment market for this project is very strong, and its proximity to Cambridge, AstraZeneca, and the other big tech companies there has really given it a lot of impetus, and we're very excited by how that project has done for us.
That's it. I don't think you compare the sort of price point there to Cambridge, the city, or even just sort of immediately around the city. I mean, the value for money you're getting and the size of the property and the quality of life you would be getting with a young family. So yeah, it's a great development, again, being driven by those things we mentioned. Okay, last one. So we recently, as some people will know watching this, some of you may have bought there, but we recently launched, or Prosperity recently launched in Sheffield, sold out within the week. So what have you got, if anything, at that sort of price point coming along, or what can you tell us if there's sort of?
Yes. I must say we launched Fargate House in Sheffield, which was 29 1 and 2 bedroom apartments right in the centre of Sheffield. We did our research on Sheffield and got all the economic indicators about why Sheffield was a really good, solid place to invest, particularly from an income yield perspective. And so we were very confident when we marketed it, but we didn't expect it to sell out within 12 days. So it's so that really did surprise us. That does show the strength in the market despite the uncertainty. So people are still out there; they do still have an appetite to buy, and I think we've got a number of people who failed to get in on that site, who are now saying, well, what's next? And when can you find me something similar? So I think that just is a really good indicator to the general strength of the market. Early in the new year, we will be launching another project in Sheffield, very, very close to
keep your ears to the ground, man. Yeah, good stuff.
So and that's going to be about another 20 units. So for anybody that feels like they missed the boat there, do get in contact with APW and register your interest. And we've got other projects, I think, coming around in that £150,000 for a 1-bed marketplace in the first 3 months of next year, centered around the East Midlands. So probably another 50 units of that kind.
Yeah.
Going back to Birmingham. Sorry, Karen.
So no, I was just going to say, that price point works very well from a sort of investment perspective, or a first-time buyer, or someone that's overseas, because once you pay your 5% and then you're paying your monthlies. I mean, I don't know off the top of my head, but I think it's sort of £1,700 or maybe even less a month. So it's a really affordable,
less than that,
price point to be paying out of out of a salary. So that's one of the reasons I think those sort of sell so well to sort of our clients anyway. But sorry, you were going to say.
And it's I think my view would be on Sheffield as an example, and Chesterfield. We've got some units in Chesterfield still available, but you can pretty much rely on getting a 6% per annum yield, which is very nice in this current climate, and you will get capital growth as well, but don't expect rip-roaring returns and capital growth, because Sheffield and Chesterfield are good places, and the values of properties there will rise in line with inflation over a 5-year period. So that's what to expect. Whereas Birmingham, because the prices are higher, the percentage yields are lower. Just that's the way rent works. It doesn't necessarily mirror exactly a percentage similarity, but we'd expect yields in Birmingham to be over 5% instead of 6% in Sheffield. But because of the dynamism of that economy, we're seeing rents rising rapidly, and also the demand for property rising because of the increasing employment. So we see capital growth rising greater there. So the combination of capital appreciation and income probably means that the return on capital over the years will be better in Birmingham over the next, let's say, 5 years.
And I think, that's another last point, everyone promise, that's I guess the importance of sort of having a conversation with someone, or doing your own research and planning at the start. If you set some clear goals for yourself, then you don't get bogged down in, where should I buy? What's the better place? If you're looking purely for yield, then somewhere like Sheffield or further north is going to be a good buy. But if you want a combination of both, then you should be looking at somewhere like Birmingham. So having some clear plans, or having those conversations, or doing your research, will help you sort of decide on what route you want to go down. Then you won't sort of get caught up in that paralysis by analysis mode. So David, thanks very much. I think we'll leave it there. Any sort of closing comments on anything we've discussed?
No, I think just the final one is we will be launching a new project in Birmingham in the new year. So for anybody who's been taken by my enthusiasm for Birmingham,
that's news to me.
That's really quite a high-end project as well. Very
Can
nice.
You say where it is, or is that?
It's going to be in Smithfield, which is about 5 minutes walk from where HS2 will be, and 5 minutes walk from the city centre as it currently stands. So prime spot.
Excellent.
It's been 4 or 5 years in the making, this one, so we're very excited about it. That'll, I think, probably February launch is where we're sitting with that one. So I think my just general advice is, over the years, I'm probably older than most of you listening. So property, we've all made money out of stocks and shares and cryptocurrency. Well, I haven't. Thank God I never. But everybody makes money out of something. There's always a good time to buy an asset class and a bad time to buy it. But the advantage with property is usually it's a good time. And for those of us who are risk averse by nature, I think it's the most important thing to have in your portfolio of assets. But I do think advice is important. We're all busy people doing our own thing and trying to earn money from our jobs or our vocations. So trying to find somebody whose advice you can rely on and who's got time to give you advice patiently is very important. So hopefully working with a company like APW and hand in hand with somebody like Prosperity is something that can help you fulfill some of your ambitions in terms of wealth accumulation over the next few years.
Excellent. Thanks, David. I think just as a final note, we'll put a recording of this out to everyone that's listening. So if you want to listen back, and if you do, you can. We'll send it out to you. And if you want to get in touch and have a chat, then please do when we send it out. Otherwise, we'll see you at the next one. And David, thank you very much again for your time. I appreciate it. Everyone listening, I'm sure, appreciates it as well.
Cool. All right. Wonderful. Thanks, everyone. Thank you.
Cheers, David. Thanks.